Way back in the olden days of the stock market, buyers and sellers would stare at a glass-encased machine that spit out strips of tape and filled with symbols and prices, watching intently as the machine went clickety-clack, clickety-clack for your latest updates. These were men smoking, complaining, pontificating, gambling. They all hung out in these parlors with these machines trying to score the next big financial gain. Some were victims of market manipulation, while others might have been the perpetrators. Today, the investing landscape is radically different. Our financial markets are more efficient and orderly today than in decades past, due in large part from the evolution of short-term speculation into long-term investing. And one of the greatest contributors to that evolution was the mutual fund. This structure allowed a professional manager or a team to perform all the work of buying and selling in stocks and place everything into an account holding, a financial basket. Now, the investing public, they purchased fractional shares of this stock basket sold by the mutual fund. This financial invention gave easy access to the average investor who, they didn't feel qualified to making investing macro decisions, right? And was more than happy to have someone else take that responsibility for them. The investors were also more than happy to pay a fee and a sales commission to participate in the mutual fund. With mutual funds, the professional money manager was born. So, I'm about to explain in 5 minutes the benefits and pitfalls to investing in ETFs or mutual funds and which ones I suggest you buy. I'm Ian Goldie. This is Finance in 5, and you're about to watch the showdown between two titans of finance, ETFs versus mutual funds. Who will reign supreme in this epic battle? Welcome. Sit down. Get comfortable. If this is the first video you're watching in my educational series for investing, then I am so glad you're here. And let me give you some quick tips for my format so you can maximize your potential to learn. My intention is to help you become the best investor possible so you can turn your dreams into goals. Up here is the subject and topic, and this space is for bullet points. Along the way, we might use a whiteboard, and when you're done with this brief 5-minute portion, there will be an extended section for those wanting to learn more, including a recap. Learn at your own pace and come back to sections you want to revisit. With that said, let's start the timer and explain the difference between ETFs and mutual funds. Look, you want to buy ETFs, not mutual funds. Spoiler alert. What? No suspense at the end? No big reveal? No build-up after 4 commercial breaks? Look, I only got 5 minutes to explain, so I might as well cut to the chase. It's because for basket investing, you want to own ETFs. And in some specialty cases, maybe mutual funds. So let's dive into details and explain why. The first mutual fund was created back in 1774 by the Dutch to finance explorers, and I explained that in our video on stock investing. When a bunch of investors pool their money to invest, the generic term is a fund. And the first funds were not open to any buyers, but exclusive to a small group of investors. Look, it would take 150 years for 1924 when Massachusetts Investors Trust offered an open-end way of buying shares of their fund, and this fund contained various stocks picked by one of their portfolio managers. It was the first mutual fund with an open-end capitalization. That meant allowing for the continuous issue and redemption of shares by the investment company. And after just 1 year, that fund grew almost 500% in assets and eventually became known as MFS Investments. Still in business today, with around $528 billion in assets. So, why were these funds so popular that assets grew so rapidly? The answer is supply and demand, a subject I covered in another video I cleverly titled Supply and Demand. So, demand was so great for ordinary investors to invest because they could easily participate in the stock market without having to figure out which stocks to buy or sell. Some professionals dealt with the daily activities of investing, and the shareholders didn't worry about the business of stock investing. Buying a basket also meant spreading out that risk over many names versus maybe just buying a few select positions based on limited investing resources. So diversification was really born for the average investor. In the early days, Mutual fund sales commissions range from 5 to 8% or more to purchase. Plus, they had high ongoing internal fees to manage the fund every year. Look, over time, with this digital innovation and competition, those commissions are almost non-existent at all today. And high internal fees have been diminishing each year. In our extended portion, I'm going to explain how innovators like Charles Schwab and John Vogel changed an industry, along with companies like Morningstar, or for that matter, the entire retirement industry. Stick around for this added knowledge so you can become the best investor possible. Then, if mutual funds were created, first, why were ETFs created and how are they different? Good question. Glad you asked. ETFs are the acronym for Exchange Traded Funds. And in my opinion, they are a superior vehicle for most investors looking for diversity. Here are some reasons I think they are better than mutual funds. First, ETFs can be traded throughout the day, and mutual funds are not redeemable until at the end of the trading day. So with funds, you don't have any idea of what price you're going to get per share to buy or sell until after the market is closed. Why? Because ETFs calculate their fractional share price constantly through the day, and they could constantly buy or sell to meet that demand for their basket. So, liquidity winner is ETFs. Mutual funds must keep cash available for possibility of redemptions, whereas an ETF can get close to fully invested. So cash efficiency, winners ETFs. As a professional, I can buy or sell a large position in ETFs in just a few seconds at a very fair price. So winner for transaction efficiency, ETFs. Sales cost and fees. Both choices have internal fees to pay for professionals and other aspects of servicing the fund. Costs are expensed as an expense ratio. And here's an example of a few expense ratios where you'll see them. In my observation, ETFs will consistently have lower fees and overall cost to buy and maintain than a mutual fund of somewhat similar investment portfolio. ETFs don't come with upfront or back-end sales charges, but some mutual funds are still sold that way. So, winner for low cost and fees, ETFs. Taxation. Well, this is very important, and many people skip over this critical detractor from mutual funds. Tax-efficient winner goes to ETFs. For right now, let's stop the clock, as my commitment was to briefly explain in 5 minutes or less, and now the winner has been crowned, and it's ETFs. So stick around for the extended version. I'll also explain technology and financial innovation, and how it's allowing ordinary investors to create their own diversified baskets for very low cost with no sales charges. There are some examples when I think a mutual fund might be better than an ETF, and I will cover that and much more in my extended version. But before you invest in more of the video, take a brief moment now to hit the like and subscribe buttons so I continue to make videos just like this for you and many others. It's the easiest thing you could do with the highest return on investment. You should tell us what you liked or how we can improve, because the goal is to empower you with knowledge so you can be the best investor possible. Share with your friends and family that you would like to see also become financially successful. I'm Ian Goldie, and this has been Finance in 5, ETFs versus mutual funds. Welcome back. Thanks for sticking around, as I know you want to gain as much knowledge as possible, and it's my distinct honor in helping you obtain that information. With that said, let's get back into ETFs versus mutual funds. I'm going to share ETFs that I like and criteria I use when researching. I'm not being compensated by any of these companies, and please understand investing involves risks of capital, no matter what you invest. But first, let me tell you about the idiot cousin of ETFs, and that would be ETNs, or exchange traded notes. Think of ETNs as the bad relative you don't want over for Thanksgiving. Wow, that's a harsh statement. Painting with a big brush of negativity, aren't we, Ian? Yes, but here's why. ETNs are structured so the company is the obligation of the assets and not the assets themselves. This means if an ETN had invested $100 million in various stocks and the company backing or issuing the ETN goes bankrupt, your money could be lost. Not on the investments in the fund, but because of the fund owner. Very dangerous structure. and one I would avoid. There are special situations where ETNs are the only structured fund basket for a special style. For example, energy pipeline companies structured as master limited partnerships. Way advanced, but simplified, this means certain companies are structured in a taxable method that might make them better to be owned in an ETN format. So, if ETNs have a specialty place, don't you think there are some mutual funds that deserve a consideration? Yes, I do. The caveat is first, they are only owned in retirement accounts. Second, they come with no sales fee to buy or sell. Third, their expense ratio is less than 1.5%. Fourth, the managers or management team is unique in some strategy or execution, and the only way to participate with these managers is via this mutual fund. Fifth is a forced decision because many retirement plans still use mutual fund structures as their only choice for participants. To better explain this, I'm going to turn it over to my partner, Adam Myers, who's back in the office. Adam, can you take it from here?
Ian, it would be my honor to help our viewers with investment choices found in retirement plans. This can be highly complicated, so let me simplify a bit with some history, because for a long time, the only way workers received a retirement plan was from their employer in the form of a pension. Workers saving for their own retirement with the possibility of the company contributing did not really start developing until the Employee Retirement Income Security Act, enacted in 1974, known as ERISA. The government decided there should be some regulation and oversight into retirement plans after discovering a good chunk of Las Vegas was built using Teamster savings. These laws help fuel the growth of investing as mutual funds and financial companies partner together to offer packaged solutions for the average worker. Suddenly, with regulation and governance, came growth as more workers grew confident with investing this way, and companies were happy to have third-party professionals help set up and administer these plans to be ERISA compliant. Many retirement plans are now offered through services such as ADP Payroll or specialty companies like The Principal. Neither of those companies sponsor this video. Most retirement plans have moved away from offering mutual funds exclusively and now offer exchange-traded funds or a combination of the two. Retirement plan companies like mutual funds because they receive fee-sharing revenue known as trails from each investment. Corporations with employees prefer this because these third-party companies were lowering their costs to administer the plans if they used mutual funds. The problem is, many common workers didn't know they were paying higher expenses due to hidden fees. Recent legislation made it mandatory for companies to disclose all fees to participants. The cost to serve the employee accounts didn't disappear because there are so many expenses for a company to enroll participants, including answering questions, providing support, maintaining proper protocols, issuing statements, filing tax forms, many more. Today, the fees are less than they were in years past, and now they're more transparent. Options for workers include the ability to obtain specialized help that comes with a higher fee. Cost and fees vary, but the bottom line is every worker should be happy if their company offers a retirement plan and ecstatic if that company offers any matching benefits. Every dollar a worker saves pre-tax is a dollar that doesn't get included in their income that year. There's an immediate tax benefit with this compounding machine of tax-deferred investing. I know Ian will cover that subject more in taxation and how to optimize your savings. That was a quick lesson on ETFs and mutual funds used in plans, and I hope this added a bit of knowledge to help our viewers. I turn it back to you, Ian.
Thanks again, Adam. I think I might be reaching back to you when we discuss the research portion. Around the same time as this 1974 ERISA laws were introduced, another piece of legislation was passed that deregulated broker commissions. The brokerage firms, they had high-priced fixed commissions. They were about to be crushed. A smart entrepreneur saw this as an opportunity to reach all the potential investors that didn't fit into this high-priced club of Wall Street and their high commissions. His name was Charles Schwab, and his firm would evolve into becoming America's largest discount broker. So suddenly, the average investor had access to 24-hour quotes and all types of resources to being the best investor possible. In the decades since Schwab formed, there's been a continued focus on financial innovation to benefit each of the client investors. Full disclosure, I have my personal accounts with Charles Schwab, and my clients are custodian at Schwab. What Schwab did for the brokerage industry, John Bogle and Vanguard did for the mutual fund industry. Now, Fast forward past disco, rock, metal, grunge, pop, hip-hop, and arrive today with Vanguard and Schwab as fierce competitors for the exact same clients. Vanguard started as a mutual fund company and quickly became a powerhouse. The term index fund was an invention of John Bogle, and today it's the single biggest way for investors to generally invest. His basic premise was this: that it's a fool's errand to try and beat the market a net of high fees using professionals, and it's better to offer a diversified basket at the lowest cost possible. Warren Buffett is one of the world's greatest investors, and he agrees with Mr. John Bogle, suggesting that most investors are just better off investing in a low-cost index fund. In the intro to this video, I stated that ETFs were better to own than mutual funds. Vanguard and Fidelity are the two biggest mutual fund creators, and they must agree with my assessment by evidence of them closing down mutual funds and their increased creation of ETFs. Today's clients have equally evolved, and low cost has been the attraction to many wealthy investors. But many a savvy investor has gained riches from just frugality. Got rich being cheap. In many ways, the digital platforms are far superior to the mentality behind walnut paneled walls. I know, because I aspired for years to one day work around walnut. In 1994, my career in finance started with cold calling, amongst many other brokers from the pit. A lovely reference of good times, the pit. Someday, my own cubicle. And possibly, if I am worthy, an office covered with walnut paneling with a view. Oh, success! Mom would be so proud. Yeah, I did that. Corner office, great money, titles, prestige, yada, 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 yada. I also put in countless 80-hour weeks for years. So back to my point on expenses and frugality, I've worked for a lot of wealthy people, and over 25 years, and everybody I've ever met, including me, wants value for what we spend our money on. Less is almost always better. Bad service is not worth any price, like week-old sushi. The exact opposite to low cost is exorbitant costs from, let's say, private hedge funds. Stanley Druckenmiller, star manager, has reportedly returned his clients 30% a year for 3 decades, net of his 25% fee and annual 2% annual maintenance fees. Are these numbers accurate? I don't know. I'm not a client, and he doesn't share his numbers with Google. But look up Forbes 500 list, and it's filled with hedge fund managers. See who's been buying what sports team or high-profile real estate and artwork. It's often a hedge fund owner. And why not? That is capitalism. Don't like them? Then go somewhere else. Wrong or right. Two different investor types and fees. My point is to be the best investor possible. Don't just focus solely on the expense of an investment, but also consider the net return potential. Another fact that affects fees is liquidity, which means on any given trading day, how many shares trades hands. A position that trades only a few shares a day, that's bad, because it means that's poor liquidity. And trading costs are going to be higher. High liquidity often means lower trading costs with tighter bid-ask spreads. In the prior hedge fund example, wealthy investors are happy to pay high fees if their net returns also have consistent high net numbers. And that's one reason why the Bernie Madoff scam was so convincing to those who desired consistency in their returns. Don't paint hedge funds as bad, because many of them might be behind your teacher, sheriff, or other pension. Just like athletes, pop singers, authors, and actors, they are compensated based on their value to others. This is capitalism. And I cover this along with fascism, socialism, and other isms in an upcoming video. Just hit the notify button, I'll let you know when it's ready. Okay, stop with the history lesson. Just tell me what ETF to buy. Totally understand, so I'll do exactly that. Here you go. For those living on your own and might be responsible for others, I personally suggest you don't invest anything with anybody until you have 3 to 6 months worth of expenses saved in cash and you have control of your personal costs in life. As a professional financial advisor, I think this is the hard stop. Don't invest until you control your costs and savings. If you're young and don't have the same responsibilities, then go ahead and start investing right away. I'm going to cover that entire process in another video for opening your first investment account and custodial accounts for minors. Disclaimer, investing can lead to losses. And at the end of this video, I'll put more legal disclaimers. Second, I'm not going to endorse any investment choice, but I will share some examples of ETFs I like and why, along with how you can better research this category for your own benefit. Now, if you're currently with a company, let's say like Schwab or Vanguard or Fidelity, they probably offer you access to free research tools already. And I suggest you learn about all those free research tools offered by your brokerage provider. So here is the process to buy an ETF. Ready? The very first thing to consider is strategy. Example, if you're starting out investing, a broad index might be the best simplified approach to investing. The best example of this would be the S&P 500 index cap-weighted. I cover capitalization in our video for stocks, but simplified, cap-weighted places more emphasis on the companies based on their value, so the top 5 companies make up, let's say, 25% or more of the index, whereas equal-weighted means each of the 500 companies contribute the same to the index. So 500 companies equally divided equals 0.2% each. The version quoted in the news or online is most likely the cap-weighted version. And broad index funds are not just for beginners, as many investors believe the only investment you should ever make is a large, diversified, low-cost index fund. There's even an entire movement called FIRE. FIRE! I'm not going to do a bad impression. FIRE is Financial Independence Retirement Early, where the backbone strategy is often cited as placing all your investments into low-cost, broad-based index funds. So, once you have determined the strategy, I think the next step is to determine if you want to add some specialty sectors to your investment portfolio, or keep it general in the form of this broad index. And because ETFs could easily be structured for a narrow or broad market, your choices as an investor are great. A broad example with focus could be investing in a high growth, mostly tech and drug companies that's found in the NASDAQ 100, symbol QQQ issued by Invesco. Narrow examples allow you to express an investing opinion without trying to pick a specific stock. A great example would be lithium stocks, as many investors believe we are moving away from petroleum and where lithium and similar companies will benefit from that. With an ETF, you could buy lithium-oriented companies or a basket which also might include some clean energy companies. However, another investor might have the exact opposite opinion, and they think oil and energy are here to stay and even grow, and they could buy a basket of frackers, drillers, pipelines, refiners, and chemical companies. This type of sector approach is also known as theme investing. If you don't have any opinions, buy the broad market index or find a professional you trust and whose investing philosophies you appreciate. Look, plug for my entire industry and try to find a professional that acts as a financial fiduciary, because they legally can't sell you any product unless it could be demonstrated why that investment choice is best for the client over the benefit to the advisor. RIAs, or registered investment advisors, are types of financial fiduciaries. My partner Adam and I are both financial fiduciaries. Like many great entrepreneurs before him, in 1984, Joe Mansueto saw an opportunity in raiding all the mutual funds that were being created. More funds meant more choices, and more choices led to more confusion on which ones to pick. So, starting from his one-room apartment in Chicago, Joe created Morningstar. Now, as a professional starting my career, I pored over the details found in a Morningstar report, and filters were delivered each month on a CD. For our younger viewers, CDs were an ancient form of digital data storage and retrieval. Now it's all online and available in seconds. Some offer free info and some must be paid for. Another financial invention is for consumers who create their own baskets for investing. This creates this diversity. Schwab has a program called Slices. Stockpile.com has something similar, and so Robinhood might offer something as well. There's a thing called motif investing, works around themes. We covered a lot of knowledge in this breakdown of mutual funds versus ETFs, and even snuck in some comments on hedge funds. The point of all this knowledge is to help you become the best investor possible and spread the word to others so your investments are not just guessing or gambling, but fueled by an education process. And this intelligence can be the foundation for a lifetime of investing. After seeing the summary, please hit the notify and subscribe button. Tell us what you like or how we can improve in the comment section. These small actions will allow us to continue to make these videos just like this. I'm Ian Goldie. This has been Finance in 5, ETFs versus mutual funds, and here is what we just covered.